You are 29 years old. You walk into a dealership on a Tuesday afternoon because you have always wanted a specific car. Black exterior, cream interior, the kind of vehicle that communicates something without announcing it. The sticker reads $178,000. You are not nervous. Your family's holding company is worth approximately $500 million. You hand over a card. It declines. Not because the account is empty. The account has $14,200 in it. That is your checking account. That is what you personally own in liquid cash on a Tuesday afternoon in a dealership that smells like new carpet and quiet money. The wealth you have spent your entire life adjacent to, the conference calls, the board dinners, the signed documents with your last name printed at the top, none of that is in the account. It is somewhere else entirely. It is structural. It is equity. It is a machine you are part of but cannot reach into like a wallet. This is the day you understand the difference. The holding company, Hargrove Capital Holdings, LLC, or whatever your family named it 23 years ago in a conference room with an attorney and a bottle of water, does not look like a bank account. It looks like this. A controlling stake in a regional manufacturing business that generates $8.2 million in EBITDA annually. 3 commercial properties, a mixed-use development in a mid-sized southeastern city, a light industrial park leased to a logistics company, and a medical office building that throws off predictable monthly rent. A 19% minority stake in a specialty insurance firm that the family has held for 11 years and cannot easily sell without triggering a right of first refusal and a tax event that would make the CFO visibly uncomfortable. A short-term treasury position sitting at approximately $14 million, which sounds like your money and is not your money. An aircraft technically owned by a separate LLC, whose operating costs are billed back to the holding company and which you have flown on 40 times without once paying for a ticket or thinking about what that meant. That is the $500 million. It is not a number in an account. It is a portfolio of positions, obligations, and legal structures, and you are a shareholder inside it. What you are not is liquid. Here is how the cap table works, simplified to the point where it is still honest. The family owns the holding company through a combination of trust and direct membership interests. Your grandfather holds super voting shares, 10 votes per unit versus 1 vote per unit for the rest. Your mother sits on the board. You own a 6.2% non-voting interest that was gifted to you in tranches beginning when you turned 21, structured specifically to stay below annual gift tax exclusion limits. That 6.2% of $500 million is $31 million on paper. You cannot spend $31 million. You cannot borrow against $31 million without the board approving the pledge. You cannot sell $31 million without triggering a right of first refusal clause that gives the family the option to buy you out first at a valuation the board controls. You feel rich. You are illiquid. These are 2 different conditions that can exist in the same body at the same time, and the cognitive dissonance of it does not fully resolve. You simply learn to carry both. Your income arrives through 3 channels, and each one has a ceiling and a mechanism attached to it. The first is your salary. You work inside one of the operating companies as a director of business development. The salary is $200 and $10,000, which is real money by any reasonable standard. It hits your account on the 15th and the last day of each month. It is also slightly below market for your role because there is an unspoken assumption, never written down but understood during every performance review, that compensation is viewed in the context of the broader family arrangement. You have never said this out loud in a meeting. You think about it sometimes on the drive home. The second channel is board fees. You sit on 2 internal boards, quarterly meetings, committee work, a fiduciary obligation that is not ceremonial. This produces roughly $48,000 per year, paid through a separate management company the family office runs. It arrives quarterly. There are quarters where it arrives late because the administrative entity had a cash timing issue and someone had to make a decision about which obligation to prioritize that week. The third channel is distributions. When the holding company has a strong year, the board votes to distribute a portion of free cash flow to members. Last year, the distribution was $1.1 million across all shareholders, and your 6.2% produced $68,200 after withholding. The year before, the board voted to reinvest. You received nothing from distributions that year. The year before that, one of the operating companies had a difficult quarter and the board suspended distributions entirely as a precaution. Your salary was fine, your personal cash position was fine. But the thing you had been quietly planning around, a commitment to a conservation land trust your college roommate runs, $400,000 pledged over 2 years, became a conversation you had to have with your family office advisor on a Thursday morning that you would rather not repeat. She said it plainly. That pledge is a governance decision, not a personal financial decision. You are going to need board alignment on this. You nodded. You understood. You did not love understanding it. Outside of the numbers, your last name operates like infrastructure. The private banker at the family's primary institution does not call you. He calls the family office, which has a managing director named Rhonda who has worked with your family for 14 years and who knows more about your financial life than you do. Vendors extend terms. Contractors take the job over others because the referral comes with a long relationship and implied future work. When you attend a business dinner in the company of your mother or grandfather, the room temperature changes. Access arrives before you ask for it. This is real. It is also a costume you wear everywhere you go, including places you would prefer to show up as simply yourself. The identity math is uncomfortable. You are an heir, which means you arrived at something rather than built it, and that distinction lives in you, whether you acknowledge it or not. You are an operator, which means you have genuine responsibilities and a role that produces real output, and you want that to be seen clearly. You are a shareholder, which means you have legal standing and economic interest and a seat in certain rooms. Each role has its own gravitational pull. Each one generates different expectations from different people. At family gatherings, your cousin who took the payout and left sometimes looks at you with something that is not quite pity and not quite envy. You have not found the word for it yet. One bad quarter does not ruin your life, but one bad quarter can mean the following: paper net worth unchanged, distribution suspended, personal cash flat, a lifestyle line item that last month felt like a personal choice and this month feels like something you need to present to a committee. That is what it means to live inside a holding company rather than beside it. The wealth is real. The ceiling above your wallet is also real. Both of these things are true every single day. The governance structure has a name for how decisions move. It is called a stack, and you learned this word in a board orientation document that was emailed to you as a PDF attachment with no subject line when you turned 26. At the top sits the Holdco board. 4 family members, including your grandfather, 2 independent directors with professional backgrounds in private equity and operations, and a general counsel who attends every meeting but does not vote. Below that, each operating company has its own board. The manufacturing business has a separate audit committee. The commercial real estate assets are managed through a property committee that meets quarterly and generates a 47-page packet that someone has to read. Below that, an investment committee reviews any capital deployment above $2 million, new positions, acquisitions, reinvestment decisions, the treasury allocation. Nothing moves without a quorum. Sitting beside all of this, not below it and not above it exactly, but adjacent in a way that touches everything, is the family office. The family office is not a building. It is a function. It employs 6 people: a managing director, 2 analysts, a controller, a tax coordinator, and an executive assistant who knows more about how this family actually operates than most of the attorneys on retainer. The family office runs reporting. It produces the consolidated monthly financial package that goes to the Holdco board. It manages diligence when a new investment is being considered. It coordinates between the CPAs, the estate attorneys, the insurance specialists, and the private banking team. It is the connective tissue. When you have a question about your economic interest, you do not call a lawyer, you call Rhonda. Now let's talk about who gets to work here and what that costs socially. The family has a written employment policy. It was drafted by an outside HR firm your grandfather hired in 2011 after a situation involving a cousin that no one discusses in specific terms. The policy requires any family member seeking a role inside an operating company to hold a relevant degree, complete a minimum of 2 years of employment outside the family enterprise, and enter at a pay band that maps to a market compensation survey. The family office updates annually. You did all of this. You did your 2 years at a regional advisory firm. You came in at the correct band. What the policy does not cover is the perception gap. There is a term some people use in financial circles, the NEPO discount. The assumption, never said in a meeting and always present in a meeting, that you are here because of the name, that your title was adjacent track rather than earned. You have delivered results that would stand on any resume. You have also inherited a last name that arrives in the room before you do, and the two things do not fully separate. Some colleagues give you the benefit of the doubt. Some spend a year watching to see if you will prove the assumption wrong. Both responses are rational. Neither is comfortable to be the subject of. The NEPO tax is the invisible surcharge on every professional relationship you build inside this structure, and you pay it continuously whether or not you made the decision that put you here. The debt is something you learned about slowly and then all at once. The holdco carries approximately $200 million in senior secured debt, currently priced at SOFR plus a spread that adjusts quarterly. The lenders are two institutional banks and a credit facility the family has maintained for over a decade. The debt is used to capitalize acquisitions, fund capital improvements in the real estate portfolio, and provide liquidity at the holdco level without triggering taxable events from asset sales. This is intelligent. This is how large private enterprises operate. It is also the thing that, in a bad enough scenario, touches your life directly. The loan covenants require the manufacturing business to maintain a fixed charge coverage ratio. If EBITDA falls below a certain threshold, the covenant is breached. A covenant breach triggers a notice period. During a notice period, distributions are frozen by default. The lender can accelerate repayment. In a worst case, the holdco board is navigating a restructuring conversation while every family member with an economic interest receives the same terse update from Rhonda at 7 in the morning. You learned this not because it happened fully. You learned it because in one difficult quarter, the coverage ratio came within 12% of the breach threshold, and the CFO presented a slide in the board meeting that used the phrase protective measures going forward. The room understood what that meant without further translation. Several family members have signed personal guarantees on specific debt tranches. Your grandfather has, your mother has. You have not yet. Whether you will is a question that will be answered at a board meeting you have not been invited to attend, but will eventually sit inside. The tax reality is its own education. The holding company uses a combination of pass-through entities and a C corporation structure, depending on the asset. Pass-through income flows to your personal return, whether or not you received a distribution. This means you can owe taxes on income you did not receive in cash. The year the board reinvested instead of distributing, you still received a K-1 that required a six-figure estimated tax payment in April. You funded it from savings. The family office sent a reminder email in February. It was not the first time you had seen the number. It was the first time you had to physically move the money yourself. The advisor ecosystem is large and expensive and not entirely aligned with you. The private banking team manages the relationship with the holdco. Their primary client is the entity, not you as an individual. The trust and estate attorneys drafted the documents that define your interest, and they were retained by your grandfather's generation to serve the continuity of the structure. The CPAs optimize at the entity level. The insurance specialists handle key person policies on your grandfather and on the CEO of the manufacturing business. Because the lenders required it as a covenant condition, and because losing either person without coverage would create a liquidity problem the rest of the family would be left holding. The valuation firm appears every 3 years and produces a report that affects gift tax filings, estate planning scenarios, and buy-sell agreement triggers. Everyone in this ecosystem is professional. Everyone is also working for the machine, and you are inside the machine. The estate planning layer is where control lives most visibly. The trust holding family membership interests are structured to retain voting authority across generations. GRATs were used to transfer appreciation out of taxable estates when asset values were lower. The family limited partnership agreements include provisions that discount minority interest for valuation purposes, which reduces gift and estate tax exposure when interests are transferred. Your 6.2% interest carries that discount. It is worth less on paper for tax purposes than it is economically. Both numbers are real. They are used in different conversations. The buy-sell agreement governs what happens if a family member wants out, dies, becomes incapacitated, or divorces. Triggering events produce valuations using a formula the family approved in 2009 and has not revisited since. Succession is not a retirement plan. It is a governance transition. Your grandfather retaining super voting shares means control is the asset, and the question of who holds that control after him is the most consequential document the attorneys are currently working on in a file you have not seen. None of this is passive. Quarterly board packs arrive the week before each meeting and run between 60 and 90 pages. Someone has to read them. You have a fiduciary duty, which means that someone is you. Annual audits of the operating companies produce findings that require responses. Risk reviews happen twice a year. Key person insurance is renewed annually. The aircraft LLC files its own return. Doing nothing inside this structure does not exist as an option. Inaction is a decision that still requires a meeting to ratify. Here's what happens when the machine stalls. Quarter 2 of a recession year. The manufacturing business loses 2 major accounts inside 6 weeks. EBITDA drops 22%. The fixed charge coverage ratio, the one the CFO showed on the slide with the phrase protective measures, crosses a threshold. Not close this time. Through it. The lenders issue a formal notice. Distributions are frozen at the holdco level pending a remediation plan. The board schedules an emergency meeting for a Thursday. You get the calendar invite at 6:47 in the morning. There is no agenda attached. Your personal budget was built around a quarterly distribution of $38,000. Not lavishly, carefully. The mortgage on your condo, the estimated tax payments, a brokerage contribution you started 3 years ago because Rhonda told you not to keep everything inside the structure. The distribution doesn't arrive. The debt service on your condo does. These two facts occupy the same month and they do not negotiate with each other. This is the liquidity trap. The holdco has $500 million in assets on paper and you are moving money from savings to cover a car payment. Both things are simultaneously true. The assets are real. The cash is not available. You are, by any reasonable definition, wealthy. You are also, in this specific moment, cash constrained in a way that feels indistinguishable from ordinary financial stress, except that you cannot explain it to anyone without the explanation sounding like a complaint no one will take seriously. The family politics arrive with the financial stress the way they always do, faster than anyone planned for. Your uncle believes the manufacturing CEO should have seen this coming. He says this in a conversation that is technically informal and functionally a lobbying effort for a board vote that hasn't been called yet. Your cousin sits on the operating board and takes it personally. His spouse sends a message to your mother about what was said. Your mother mentions it to your grandfather. Your grandfather says nothing in response and everything in tone. A sibling compares distributions, compares titles, compares whose name appears on which committee. Board seats. In this moment, stop being governance responsibilities and start being currency. Who holds one, who wants one, who was promised one and hasn't received it yet. The attorneys quietly begin preparing for scenarios no one is saying out loud. This is what governance failure looks like from the inside. Your grandfather built this. The structure reflects his judgment, his timing, his risk tolerance, his relationships with the lenders. That was appropriate when he was the only decision maker and the company was a fraction of its current size. It is less appropriate now. The succession document the attorneys are working on remains unfinished. The buy-sell agreement formula hasn't been updated in 16 years. 2 operating boards include family members whose roles were created rather than required. One significant capital decision was made in a phone call between your grandfather and the CFO that was ratified in the following board meeting as though it had originated there. Shadow decision-making doesn't announce itself. It appears in the minutes as a motion that passed unanimously. External shocks concentrate differently inside a holding company than they do in a single business. A lawsuit against a commercial real estate subsidiary creates a reputational surface that touches the manufacturing brand. A tenant default in one property affects the collateral package that the lender is watching. A key executive departs the manufacturing business during the remediation window, and the departure triggers a key person insurance review that the lenders requested as a condition of waiving the covenant breach. Every risk that would be contained in a standalone company moves through the holdco like weather through a single building. Nothing is fully isolated. Everything shares the same walls. The emotional cost doesn't have a line item. There is a specific anxiety that lives inside inherited wealth that has no clean name. It is not gratitude and it is not guilt exactly. It is closer to performance pressure that never clocks out. The question of whether you belong here, whether you have done enough to justify the seat, whether the people around you are measuring you against a standard they won't say out loud. Add a liquidity freeze and a family conflict and a board meeting with no agenda, and that anxiety sharpens into something that can be difficult to locate as a source of what you're feeling. You don't tell people you're struggling because the context makes the struggle sound like ingratitude. So you hold it. Most people in your position hold it. Here is the framework that holds under pressure. Separate your identity from your capitalization. Respect governance even when it slows things down, because the alternative is the phone call at 6:47 in the morning. Maintain personal liquidity that exists entirely outside the distribution cycle. Know what your economic interest actually says, not what you've been told it says. The machine is real. So is everything that can stop it. Tell us in the comments which part of this structure you want to go deeper on next.